Yeah, let's don't go too early because people probably won't come on right at until right at 11 o'clock.
Yeah.
So, well, we're not opening. We just have a slide showing.
Oh, okay. Yeah, okay.
Yeah, slide. Okay.
Good morning. Welcome to the BYU Marriott Real Estate Webinar Series. My name is Barrett, Slade, Professor of Finance and the host of today's webinar. We hope you had a great summer and are ready to join us as we begin our 4th season with the webinar series. We invite those of you who have a question during the presentation to click on the Q&A button at the bottom of your screen and type those in, and then we'll get to those as time permits. So today we have with us Mr. Michael Acton, Managing Director and Head of Research at AEW in Boston. Mike, welcome. It's great to have you with us. I don't know if you recall, but you were our first webinar presenter when we started this in September of 2020, right in the thick of COVID. And you were kind enough to keep us appraised of market conditions, and it sounds like it ain't over till it's over. So you have us in suspense, and so thank you so much. Please take a minute and tell us a little bit about yourself and then dive into your presentation. We're excited to have you with us.
Great, and thank you, Barrett, and thank you everyone at BYU for having me back again. I can't believe it's been that long since we've done that. Obviously, a lot's changed, and we'll try to touch on some of that in the course of all this. For those who don't know, I'm the managing director for research at AEW Capital Management. AEW is a global investment management firm. We've been in business since 1981, and believe it or not, I've been at AEW since 1990, so a really long time. Been through a lot of cycles. Each one's a little different. Been very, very interesting for me to watch how the real estate business has grown and transformed over all the years. On a personal side, my wife Miriam and I have been married for 36 years this year. We live in a very historic town outside of Boston called Harvard. And I have 3 adult daughters who are all really accomplished academics and researchers and things like that. So with that, I guess I should go ahead and maybe share my screen, Barrett, is that right?
Yes, go ahead and share your screen.
Okay, and share a screen here. And I think Barrett sort of highlighted the title here. We always try to come up with an interesting title for our presentation, something that sort of captures the moment. I love Yogi Berra. I thought he was a great catcher, of course, but I thought he was a really interesting philosopher, if you will. He had many famous sayings. "It ain't over till it's over" is one of his more famous. Some of my other favorites of his, of course, are things like predictions are really hard, especially about the future. If you want to keep it to real estate, he once said, "Nobody goes there anymore. It's too crowded." So really, really interesting and insightful guy. Hopefully the title will all make sense as I go through this. And I'm going to speak for about 30 minutes or so, and I'll go through material relatively quickly, and then we'll get to your questions towards the end. So just moving ahead here. Lower for longer, no longer. We play with words a lot. I like to play with words. For many, many years after the financial crisis, we were in an environment that people described as lower for longer. The idea that central banks would keep interest rates abnormally low for a lot of valid policy reasons, stimulating growth, recovering from the effects of the financial crisis, much more recently trying to combat the negative effects of the pandemic and so on. But in my opinion, we've clearly moved into an environment where interest rates are not going to go back to being lower, certainly not anytime soon. And I think the Fed's really done a really good job of signaling that. Maya Angelou once said, when someone tells you who they really are, you should believe them. Well, Jay Powell and the FOMC have been telling us for well over a year now that they are indeed recession fighters. They might have gotten to that fight a little bit late. I can understand that. We were still in COVID and trying to figure all that out. So they came a little bit late. Inflation got a little bit out of hand, but they have very much committed to fighting inflation. So we assume, we take them at their word that rates are going to stay elevated at least through next year. It's going to be a very, very long time till we get back to what they refer to as the neutral rate, the rate where it's neither contributing to expansion or contracting the economy. Probably a number in the, say, 2.5% to 3% range on the federal funds rate. Many market participants, certainly in the equity markets, have really moved past the concern about recession and have really moved to a point where they truly believe we're going to orchestrate the so-called soft landing. The Fed's going to do everything exactly perfectly. The economy is not going to tip into recession, and miraculously, the Fed will come to their senses and lower interest rates. As I said, I don't think the interest rate part's going to happen, at least not anytime soon. There's many recession indicators still flashing bright red. I'll get to that in a minute. Maybe this time's different. I think Sir John Templeton taught us that this time is different are probably the most dangerous words in the investment business. I'll explain that in a second when we get to recessions. The real issue in the commercial property markets so far, as of right today, the real issue is an issue about credit constraint, credit availability. It really isn't much about operating performance in the properties. Office properties are a bit of a different story there, and we'll get to that. But it really is that the credit is highly constrained, transactions are very limited, and the bid-ask spread between what buyers want and what sellers are willing to do is very, very wide today. And I think that continues at least through the end of the year. Private markets, by their very nature, lag public markets. The stock market, the bond market, the REIT market, they all sold off last year. About a year later, private markets start to adjust. This has happened in cycle after cycle. I constantly explain to our investors that this is not a problem with private markets. It's actually a feature. It's a real advantage for a CIO to be able to blend publicly traded assets with privately traded assets and smooth out the earnings, if you will, over the entire cycle. And that's very much what's happening. Private values are catching up to what happened in the public market, but it takes time. Probably plays out through the end of this year, maybe even to the beginning of next year. There's two real stress points in the market today. The first, obviously, is any loan that's maturing is a discussion. It can be a problem too. If the cash flows of the property are uncertain, that would largely be things like office properties today. It's going to be difficult to find a lender that is really interested in refinancing that property. And if the values have changed much, and I'll show data on this in a minute, if the values have changed much since the loan was originated, it could be quite a bit difficult to refinance. And of course, even if you find a new loan, it's going to be at a much higher interest rate. So that's yet another issue. The other stress point in the market today, of course, is leases maturing, particularly office leases. A lot of uncertainty about office tenants. So far, over the last couple of years, most office lease maturities have resulted in downsizing of office space. I think that continues, at least in the near term. It's a big decision for the property owner, for the landlord. You really have to understand how much equity you're really protecting in that property, and whether you're protecting your equity or you're just improving your lender's position. So those are the two big touch points. I do think once we get past this 2024 and beyond, it should shape up to be an incredibly interesting and very fertile investment environment for a whole bunch of strategies. We've experienced this coming out of the GFC, earlier coming out of the savings and loan crisis. The period after the downturn in commercial property typically shows really outsized returns. And I think everybody on this call, anybody who's interested in being in the investment business, should really be cheering for an environment where we don't go back to quantitative easing, We don't go back to zero interest rates. Those were important tools for very specific crises, but they shouldn't be the steady state of the world. Capital markets, particularly the US capital market, is incredibly good at allocating scarce capital, but it needs a true price signal. And if we distort prices, the cost of capital, interest rates, in other words, we're going to misallocate capital as a society. And I think we've probably done a bunch of that over the last 15 years. And maybe towards the end we can talk about that some more. So getting to the Fed every other meeting they issue guidance. They call it forward guidance on what's going to happen to interest rates, the FOMC, the so-called dot plot, and so on. These are the last 5 FOMC meetings where they released that information, and it's been a pretty consistent story. They keep pulling forward the pacing of interest rate increases. They keep raising what they call the terminal rate, the rate at which they stop raising, and then where they back off to over time. In the most recent meeting, of course, in June, they said they're going to take the Fed funds rate to something like 5.5%. They're going to keep it above 5% right through this year, right into the end of next year. They'll still be very close to 5% at the end of next year. And what I added on the right-hand side of this chart is a quote from Bill Dudley. Some of you might remember Bill Dudley was the head of the New York Fed, perhaps the most important of the Fed member banks. And he was there during the GFC period. He was a member of the FOMC. This was an editorial that he wrote at the very end of June on Bloomberg, laying out just sort of the back of the envelope mental calculation for what does this all mean for where the 10-year Treasury is gonna land. And he makes a very convincing case that we should be thinking of a 10-year Treasury, about 4.5% or so. I saw Larry Summers about a week ago laying out basically the same math, only he came to a number closer to 5. So I think for planning purposes, we should be thinking that the 10-year, which many things price off of in our capital markets, the 10-year should probably be somewhere around 4.5 to 5. It's about 4.25 today. That's all fine. The 10-year Treasury yield before the financial crisis in 2007 was indeed 5%. Hasn't been 5% in a very, very long time. And if you look at where properties are priced today, just look at the NCREIF property index. Many properties are priced at current yields well inside of those kind of numbers. I mentioned recession indicators. Each of these charts, the blue bars, show past recessions. The red bar on the left, the red line on the left, that's a very simple chart. It's just the spread between the 10-year Treasury yield and the 3-month Treasury yield. In other words, the steepness of the yield curve. We could have used the 10-year and the 2-year. Some people use that. It shows basically the same thing. This indicator has been a very, very strong predictor of economic downturns. Pretty much never wrong in the post-war period. And it's been signaling very strongly that the bond market thinks we're going to have a recession sometime in the next year. You will note that the recessions typically don't start until the yield curve starts to flatten out. In other words, that red line starts coming up. And we're really just at the beginning of that right now. The right-hand side chart is something much more fundamental. It's the year-over-year change in the Conference Board series of leading economic indicators. Real fundamental stuff: consumer confidence, retail sales, what's the stock market doing, housing starts, things like that. That has also been a very, very good predictor of economic contractions. And again, it's been signaling economic downturn now for well over a year. So I don't know for sure we're going to have a recession. I don't think anybody can know that. There are things that are different this time. The biggest difference is collectively as a country, we injected trillions of dollars into our economy as COVID hit, well in advance of any sort of normal business cycle type contraction. We've never done that before. We've never preloaded the economy with that much stimulus. So maybe that softens this. Maybe we somehow only have a mild recession. Maybe somehow we avoid it. But I think you can't take the risk off the table. You have to at least have a scenario in your planning where what are we going to do if we also get recession on top of everything else. So far, it's all been about changes in the yield environment, the capital market environment, the cost of capital. That's been what's vexing real estate. We really haven't had the real meaningful disruptions to property operating fundamentals that would come with economic contraction. This next page is maybe the most important chart in here, though I'm going to say that 2 or 3 more times because there's a couple others that are equally important. The blue line on here is a composite of a survey the Fed does with loan officers at banks that belong to the Federal Reserve System. They do this every quarter. The data comes out interquarter, so the last data point was August. The blue line, when it's negative, says that bank lending officers are constraining the availability of capital for commercial properties, stabilized properties, and development. The last time it was this negative, this constraint on bank lending, was in the GFC period. The most recent data point tipped up just a little bit, and that gave some people, I think, confidence that maybe we're past the worst of the constraint on banks for lending on property. I wouldn't read too much into that. I just grabbed some headlines and glued them into the right-hand side of the chart of things that have just happened in the last few weeks of Moody's downgrading more banks, S&P downgrading more banks, Fitch downgrading the United States government itself, and then also issuing a report saying that they are reviewing the credit of all banks, including the money center banks, the Wells and the JP Morgans and the Bank of America, and that there's very likely going to be more downgrades for everyone, including the money center banks, the so-called too big to fail banks. Now, the other line on here is equally important. That's the year-over-year change in the capital value index from the NCREIF universe, the institutional property universe. And I think you can see pretty clearly that values start to decline about a year after credit market conditions tighten. And so credit market conditions have tightened over the past year here. Values are just starting to go down. I think that little blue line is probably going to go down more before it comes back up. So this repricing of the commercial property sector probably has a bit more time in it. It's not happening really as fast as maybe many people would hope. The real issue for property, of course, is that a lot of people like to use financial leverage, financial gearing. It's an asset class that lends itself incredibly well to financing. It has very, very strong cash flow characteristics, and you can use those cash flow characteristics to support a reasonable amount of financing. So the chart on here is really quite simple. The blue line is the average yield, the average cap rate on a property in the NCREIF universe. The yellow line is the all-in borrowing cost on a loan originated in that quarter by a balance sheet lender. This data comes from the American Council of Life Insurers. So these are life company lenders who hold on balance sheet, underwrite really, really well because they're going to hold them. But the red line is the blue line levered at by the yellow line at 50% LTV. And you can see the leverage is not accretive anymore. The leverage has made the levered yield, the cost of that debt has made the levered yield far below the unlevered yield. So the financing just really doesn't work. Properties, generally speaking, need current yield above the borrowing cost for everything to make sense. They certainly need current yield above the treasury to make sense. And we're just not there, broadly speaking. You can look at it a lot of different ways. You can look at that average property yield compared to treasuries and compared to the corporate bond yield. I use the BAA intermediate. I think it fits the best. You can see most times the red line there, the average property yield, is pretty much on top of where the average corporate bond yield is. And I think that makes sense if we're really honest with ourselves. Our tenant base on average is roughly around investment grade. They should have yields that are somewhat comparable, I think. But today they're very, very far apart. You could look over on the right-hand side. You could look at the appraisal-based yields, the yields on the books. That's what they're actually on the books at. The yellow line is the yield on the properties that traded that quarter, and the blue line is the yield, what's called the implied yield from the REIT universe. If you know what your NAV is and you know what the price of the stock is, you can back into an implied cap rate. And in this case, I kept both of these things to just the 4 major property types, equally weighted, just to be fair. Don't want differences in property allocation and things like that to color the result. And it all says that property yields need to be higher. Now, property yields can get higher 2 ways. One's fun. You grow the income, your NOI grows, your rent grows, you keep your expenses under control. That's the fun way. The less fun way, of course, is the values adjust downward, and that brings the yield up ultimately. I said earlier that the private markets always follow the public markets. The left-hand side here is just a simple illustration. Total return indices, they set equal to 100 at the end of 2021. The lines on the bottom, the equity REIT market, the S&P, investment grade corporates, those are all publicly traded assets. They sold off quite a bit in 2022, coming back up here in 2023. The lines on the top are the NCREIF property index, an unlevered property level return index, and then ODCE, the Odyssey, the open-ended core fund universe. These are fund level returns using some leverage, about 25% leverage or so. And they continued to go up in 2022, and now they're coming down. If you look to the right-hand side, and just another way of looking at it, the NCREIF Capital Value Index, the blue line, just laid up against the NAREIT REIT Share Price Index. They're not measuring exactly the same thing. A share price and a capital value index, they're not exactly the same thing. But historically, they have moved together through time. And I think you can see back in the 2008, 2009 period, REIT market sold off very sharply, well in advance of the private market. Actually, when peak to trough, it went down about 75%. About a year later, the private market, the blue line, started to go down. It went down about half as much. And the main reason why it went down about half as much is because by the time it was going down, the REIT market was already coming back up. And that gave valuation people, that gave transaction people something to point to say, yeah, the values don't really have to go down as much as they did in the REIT market. And then if you fast forward to the end of these lines, you can see the same thing playing out. REIT market sold off pretty significantly in 2022, starting to come back up. In the private market, just about halfway through, maybe its correction in those same values. Now, everything I've said has led to highly constrained transaction market, highly constrained capital market. These lines on here are showing total commercial property transaction volume cumulatively through each year. So you start at January, you add on what happens in February, you add on what happens in March, and you go right through the year. And I've shown you each of the years, including this year, all the way back to 2019. So you can see 2019 was a reasonably strong year. The COVID year, 2020, it really dropped off. You really couldn't buy a lot of properties. People couldn't go visit them, that sort of thing. Came back very strongly in 2021. Federal Reserve took interest rates down to zero again. Borrowing costs got very low. And of course, transaction activity picked up. 2022 was a great year. It started off incredibly strong. It was going to be the strongest transaction year ever until about midway through the year when the banks began to get the message from their regulators. It started with the money center banks. They have regulators that live in their space. And they started calling us and saying, hey, we're done. We're not writing any more loans this year. And then as the year went on from there, it spread into the regional banks, and then finally by the end of the year, the smaller banks, and it's really bent the trajectory. And then you look down the bottom, 2023, this year, with a really constrained financing market, we're running at a pace that is currently it's below the pacing of the COVID year. And that's a pretty dramatic statement to make. There's maybe a more profound way of looking at all of this, of course. These bars on here are showing the total transaction volume for all property sectors. Each bar represents the sum of the previous 4 quarters. We got to a point in the middle of 2022 where collectively we deployed over $1 trillion of capital on a trailing 4-quarter basis. The most capital ever deployed by a lot. But most importantly is the blue line. That's the average yield of those properties. So most capital ever deployed by a lot at the lowest yields ever bid by a lot. Really, really low yields there in the middle of 2022. That's all fine as far as it goes. If you dig deeper into this, what you discover pretty quickly is that almost all of this increase in transaction volume and compression in yield happened in 2 property sectors. No surprise, the 2 property sectors that have consistently had the strongest cash flow characteristics over the last 5 or more years: apartment properties and industrial properties. So really dramatic increases in transaction volume for both property sectors, but with really meaningful yield compression in both. I think these sectors still have plenty of good news ahead as far as cash flow growth, operating fundamentals, and so on. But having so much capital deployed, and let's face it, most assets repriced to these low yields, whether one transacted or not, I think that's going to be a drag on performance for several years to come because these yields are simply too low. The average yield on a property in Maycreef today, apartment property, is right around 4%. The average yield on an industrial property in Maycreef is about 3.6%. Industrial, of course, has a whole backstory of rents rolling up. Most of the rents in place are far below where market rents are. But even when you adjust for that, the yields are too low. So they're going to have to grow into their yields either by moving the income even more or some adjustment to value. Now, the thing that's really going to bring a lot of this to a head is loan maturities. There's about $5 trillion of commercial property loans outstanding in the United States. On average, they're 5-year loans. So every year, there's roughly something in the ballpark of $1 trillion of loans that should be maturing. These numbers aren't quite at the $1 trillion mark because loans also have extension options built into them and so on. So over the next couple of years, there's $1.5 to $2 trillion of commercial property loans that are going to need to be refinanced. On the left-hand side, I'm showing you who holds those loans. A lot of them are bank loans in the near term. Those are going to be tough. Banks have gotten the message that they need to shrink their real estate books, not grow them. And then on the right-hand side, it's broken out by property sector. And again, you can see a lot of them, at least in the near term, a lot of them are going to be office property loans, and those are going to be hard. Those are going to be hard to refinance. And the main reason I say that is because of what's happened since these loans were originated. This chart's a little complicated, so I'll take a little bit extra time explaining it. But the blue bars are the average loan to value on the left-hand side. Anyway, we'll start with that. Left-hand side, office loans. The blue bars are the average loan to value when those loans were originated in that year. So the very first set of columns, the blue bar, 2015, those office loans were a little bit below 60% average LTV. I've adjusted that LTV by how much valuations have changed since then. Use Green Street's repeat sales index, their CPPI index, to adjust those. And assuming no amortization, that same loan that was originated at less than 60% in 2015 is now a 75% loan. The red line on here, of course, is the average borrowing cost for these loans, pretty stable through most of that period, dipped in 2020, 2021 when the Fed took interest rates to zero. But now that borrowing cost is soaring. So if you had a loan that was originated, pick your year, maybe 5 years ago, 2018, it was a 55% loan then, now it's an 80% loan. You go to refinance that. If you can even find a borrower that wants to work with you, they might give you a 40, 45, maybe in some cases a 50% loan, but it's a 50% loan on a much lower property value. So you have a lot of missing equity, if you will. There's a big funding gap there that someone's going to have to make good on. Either someone's going to have to put new equity into it, or the property is going to go back to the lender. I would say our experience right now, this is all anecdotal, but our experience is that lenders are really reluctant to take these assets. Back in the financial crisis, you could probably convince yourself that if you can get things out into the future, it's probably going to be better. Recession had already happened. The Fed was coming with lots of liquidity. Maybe you wanted to push things out into the future. Today, certainly in the office sector, I think it's a much harder story to make. We haven't had a recession yet. Maybe we will, maybe we won't, but it hasn't happened yet. The Fed's draining liquidity from the financial system at a pretty good pace. So it's hard. It's a much harder story to convince yourself that there's a better day ahead for a property where the cash flow is uncertain, like a lot of office buildings. On the right-hand side, industrial, probably pretty different, right? Industrial values have gone up a lot since these earlier times. These LTVs on the existing loans are quite low. You can probably retire the loan. In other words, get a new loan with enough proceeds to pay it off and not have to come out of pocket with new capital. So very, very different story by each of the property sectors. And then in the couple minutes we have left here before Q&A, I'm just going to touch on office properties and then hopefully leave you with something that's a little bit more positive than most of what I've been saying here. So office property sector, this is a nice new modern office building. I'm sure if you go into any new office building in the country, it looks something like this. We've titled this "The Elephant Not in the Room." And we're not trying to make a joke here or anything, but I travel around the country, around the world a lot, talking to our investors. And it's pretty stark in some places how few people are back in the office on a regular basis. I think there's very few companies that are truly trying to be fully remote anymore, but almost everyone has adopted some form of the hybrid model in some days, not in some other days. And office tenants are really struggling with, one, how much office space they need, and two, if they're gonna take new space or renew their lease, what do they want that space to look like? And it's pretty different. Generally speaking, tenants have been reducing their footprints, though that's hard to do, admittedly, if you're going to have everybody in on any given day, very hard to do. But what they want is they want a lot more joint space, event space, activity space. If people are coming all the way into the office, they're not coming in to do heads down work in a room with a door closed or putting on headphones and being on Zoom calls all day. Generally speaking, they're coming in to do collaborative work, training, mentoring, team building, strategy sessions, things like that. So you need a very, very different space. The real issue for somebody like me, selfishly, is it used to be pretty easy to forecast office demand, office absorption. All I had to really do was look at the really good data the government produces on office employment growth. And there was a very strong relationship between office employment growth and office space absorption. That relationship has completely broken in the last 2 years. We've actually added quite a few office jobs, jobs that historically would have shown up in an office space. We've had pretty good growth in that. The chart on the right says that we're almost up to 10% more office jobs than we had back before COVID. That's what that blue line says. The yellow line, though, and this is the data from Castle, you've probably seen this, it's in the Wall Street Journal every week. It's not perfect. I think order of magnitude is probably correct. I think directionally it's probably correct. But that data is measuring true space utilization, how many people are actually in the space in any given week. Varies a lot by day, of course. The middle days have more, the Mondays and Fridays have less. But when you average it out across the week, the country as a whole is running at about 50% of daily utilization. I have a very old school view of real estate. I think it's just a factor of production for a business. You use it like you use other capital. You use it like you use labor. If it's really valuable to you, you'll pay more for it. That means the rents go up. If that goes on long enough, those higher rents are capitalized into the value. But if the space isn't as valuable for you, it's a natural reaction to want to spend less on it, like you would for any other input. And I think that's really what's going on in office properties today, that the space is not as germane to the business as it once was. It's not adding as much value to the business as it once was. And tenants are very correctly, I think, assigning less value to it and ultimately lower rent. And I think that goes on for a very, very long period of time. The problems that's causing in the debt markets and in other things is just starting. We're in very, very early days in here. This is the data from TREP. It's the delinquency rate on office CMBS loans and the percentage of those loans that have moved into special servicing. They're just starting to curl up now. I think they're going to go up quite a bit over the next couple of years. There's going to be an awful lot of borrowers who are going to do the math. They're going to look at everything and they're going to say, you know what, the sunk cost fallacy is a real thing. It does not make sense to keep putting more money into these assets. Lenders are going to fight to not take it back. I think you're going to see a much faster move to short sales and things that make it so that the property never actually touches the lender's balance sheet. They don't want it. They don't want the regulatory problems that creates for them, the capital reserve requirements that creates for them, and so on. So everything I just said there is a little hard. It's a tough message, but I am going to leave you with a positive thought here. This line here is very simple. It's the NCREIF Capital Value Index during the financial crisis period. I've circled the U, if you will, on the bottom. A portfolio manager that worked at AEW when I first joined back in the early 90s said to me once, and I thought it was really smart. He said, look, I don't need to call the bottom. I just need to be somewhere in that little U, and that'll all work out fine. we've had a lot of clients asking us, tell us when the bottom is. We're ready to allocate. We want to get back in, but we want to know, we're at the bottom. And what I've been trying to convince them is you don't really have to be at the absolute bottom if you're a long-term investor. So the table on the right, very simple. Each of the last 3 cycles, I identify the trough quarter, calculate the go-forward 5-year return from that trough. Big outsized numbers, low double-digit numbers for core. This is for Odyssey. These are core returns. Low double digits is a really good return on a core strategy. But then just for the sake of argument, I moved that 1 quarter and 2 quarters before and after and calculated the same thing. And the numbers really aren't all that different. I was showing this to a public plan CIO last week. He kind of thought about it for a minute, sort of mulled it over, and he said, well, if this is all right, I want to be 1 or 2 quarters early. And I said, I agree, but I'd like you to say why you think that's the case, to see if we're looking at it the same way. And he said, well, all these core funds all have big redemption queues. If I'm a quarter or 2 early, I'll get all my money called and I'll fully participate in that run up. If I'm a quarter or 2 late, a lot of people in these queues may have rescinded their redemption, and I may suddenly be in a line to get my capital called that might go 12, 18, 24 months before I get my capital called, and I'll miss out on a lot of that. And I said, I think you're absolutely right, but I wanted to hear you. I wanted to hear you say it. So I think we've covered all of this. Property pricing's underway. It takes, it's going to take all of this year at least. Office really is the new retail. All the things vexing retail over the last 10 years, largely technology allowing us to shop differently at different times. Technology is now allowing us to work when and where we want, under whatever conditions. Leasing is going to be really big decisions, especially if there's a big capital investment check, a tenant improvement check. There's going to be a lot of need for fresh equity, fresh debt to redo these capital structures. We saw this after the financial crisis. It took maybe 2 years before that really started to materialize in the financial crisis. This time, I think it's going to happen a lot faster. These normalizing yields are really good for the next cycle. And what I mean by that is most of our investors need to make a 7. Pension fund needs to make about a 7. That's their actuarial rate. If they can start at a property yield that's like a 5, 5.5, they don't have to take a lot of tail risk. They don't have to take a lot of residual risk to make their returns. I think everyone will be happier. And then bigger picture, the end of 0 interest rates, the end of QE is just uniformly a good thing. Treasury bonds should have a positive real yield, period. Everybody's life works better when it does. Capital markets get more efficient. And selfishly, I think if you're in a world where capital has true cost, differences between investment managers get wider, not narrower. When interest rates are 0, in hindsight, the best thing to do is the riskiest thing to do. When interest rates are real numbers, that's when real capability, real expertise gets rewarded. So with that, I'm going to stop here, I think. There we go.
Okay. Mike, that was really, really insightful. Appreciate it. Let me throw out some questions to you that we've received and invite those who are on the call, if they'd like to go and submit their questions, that would be great. We have one that is as follows. Is it possible that the relationship between real estate assets and the 10-year treasury is fundamentally different today?
It's always possible. As I said with Sir Templeton's quote there, this time is different is a very dangerous phrase. There was a period before 1990 where property yields were consistently below the 10-year treasury. That's a little bit before my time at AEW. I never really understood it. I never really got a very good explanation from the people who were there before me. I do think it was a weight of capital kind of story. Some people try to tell a story that, well, real estate's really an inflation hedge, and just like treasury indexed inflations have a lower yield than nominal treasury bonds, property, if it's a true inflation hedge, can trade at a yield inside of that. I think that's a really interesting intellectual argument. I don't think anybody's really deploying capital on that thesis today. So I would think that properties should have a yield that's north of the risk-free rate. But again, I'm old school. Maybe one of these younger people who's coming along listening today will write a paper or something that explains why that all makes sense to have yields inside of treasuries.
Great, thank you. While we're waiting for a question, I've been recently working on a research project that looks at the determinants of cap rates from a capital markets perspective, and using the ACLI data, it's been interesting to see the debt coverage ratios declining significantly as interest rates have increased, it's just, you kind of wonder how far can they go. Cap rates have gone up much slower than interest rates, and that's forcing the coverage ratios to decline. But at some point, lenders are saying, hey, we've got to have some coverage there. And speak to kind of this dilemma that lenders are kind of finding themselves in.
Yeah, I think lenders, particularly the traditional lenders, have a real problem. The smaller and regional banks in particular, after the GFC, the big banks entered a regulatory regime that was very constraining for them. They got regulators put in their offices. They were told to shrink their share of their book that was in commercial property and not let it go back. And they did that. The smaller banks, the regional banks, took that market share and really enjoyed a 15-year run of values basically going straight up. And it all was very reaffirming for them. But I think they've allowed their books to become too much commercial property, probably. So they're going to be under pressure to shrink their exposure to real estate as well. And that's not going to come back for years. So somebody else is going to have to step into that void, if you will. Life companies, of course, will keep doing what they do. They have an allocation for CRE debt. They'll keep doing that. But the real where it's going to really be made up is in private credit debt funds. They're going to have to make up the difference. They can be probably a little bit more creative, but they're going to want high yield. They're going to want probably more covenants, more restrictions, if you will. So it's all going to stay harder for commercial property than it's been. We've just gone through this really a remarkable 15-year period where interest rates were very, very low and debt was very, very plentiful. And it doesn't seem likely it's going to go back to anything like that, really probably for quite a while. And yes, I think lenders are really struggling really with all of that.
Yes, thank you. I'd like your thoughts with regards to the hybrid versus fully in office, as well as fully remote. Do you believe that things have really settled down now into more of a steady state, or do you believe the jury is still out, and that do we really have the data to show that our employment base can be as productive in a hybrid or a remote versus in office? Some of your thoughts as you've traveled the world and spoken with different investors and seen office space. What's going on?
Yeah, I would say in the U.S., probably Australia, I would throw in there too. This hybrid model seems to have fully taken hold. People want the flexibility to not have to come to the office every single day. And that desire was probably there before, but there was probably social and political pressure to not do that, right? But COVID proved you could do it, and people did for going on 3 years. If COVID had lasted 3 months instead of 3 years, we probably would have snapped right back. Employers, for different reasons, are trying things to get people to come back more often. Some of them are the more draconian approach. That would be maybe like, Goldman Sachs is probably at the front of that movement, right? You got to be in the office 5 days, period. Other companies are saying we'd like you here more often than not. Maybe that means 3 days. Every company is going to find their natural pivot point, if you will, their balance in all of that. As far as the productivity goes, I think the jury's very much out. Early on, it seemed to all be working. Economy kept running. Everybody seemed to be getting everything done. Having said all that, the aggregate productivity data of the United States over the last 3 years has been incredibly weak. I don't think it's all just coming from the office sector, of course. I think one thing that happened is an awful lot of employees in a lot of jobs in the United States changed jobs during COVID and the period immediately after COVID. And there's some learning curve, of course, particularly if you change entire industries. So I don't think we'll know for a few years the true productivity impact. I think there's very positive social benefits, family benefits to having a more flexible workplace, and that should show up in some data somewhere. But it's a giant experiment. In Asia, everybody's back in the office except in Australia. They never really left the office. I'd say Europe is a little bit of a in-betweener of those two things. Yeah, I've been in Europe a couple times in the past year, and people talk a good game about being back in the office, but most of the office properties I have visited were pretty sparsely attended on the days that I was there. Maybe it was just that day or whatever, but I think people innately like having more flexibility rather than less.
Yes. Okay. Thank you. Here's a question. With the talk of rising LTVs, loan to value ratios, over time, and the restricted appetite of banks around restructures, do you see more mezz and other players trying to fill the equity gap if sponsors aren't willing to bring in the equity or more short sells? It's quite a
Yeah. We're going to have more creative capital structures. That's going to involve, of course, senior loans, but it's going to involve subordinated loans as well. Some of the players, existing players who participate in that space, of course, are having their own issues with their own credit lines being called or limited as well. A lot of the existing debt funds do have leverage upon leverage, right? So they're facing the same constriction on their credit. But to get this all worked through, people are going to have to be pretty creative, come up with new solutions, and it's going to be new people doing it. I think it's not going to be all of the same traditional players that you would have seen maybe in the post GFC period. Those will certainly be there as well. The opportunity funds will be in there. They'll be buying properties through the debt. The debt funds, of course, will be trying to work out a solution that gets the property refinanced. The real problem is that in many cases, it's very, very difficult to get to the proceeds needed to retire the current debt balance. And that's when somebody's going to have to step up with fresh equity. And and particularly in office, that's a really hard call. You really have to understand what your true equity position is. Got to be really honest with yourself.
Great. Well, Mike, we're nearing the end. We just can't thank you enough for taking your time. You're always so insightful. So thank you. Would you, we have students on the call as well.
Mm-hmm.
And I always like to just allow the presenter a minute or two to share a nugget of wisdom. If you were a young professional or someone even still in graduate school or finance major, whatever you're getting ready to graduate, just a young person, over the years, what can you share with them that might help them as they go forward?
Yeah, sure. And thank you again for inviting me today. This has been great. What I would say to this particular cohort of young people is you really should pat yourself on the back. Your generation has just gone through one of the most extraordinary events for somebody who's trying to get through, whether it was high school, college, graduate school, wherever you were in all of that, when the pandemic unfolded. The impact on you and your friends and your cohort was simply extraordinary. I have three children who were in various stages of that as well. I think you should take a lot of comfort in the fact that if you got through all of that and you're still doing well, and you've been able to accomplish what you want to accomplish, that's a remarkable achievement. But what I would say on a go-forward basis is you really need to create network. You need to create community, create support systems, find mentors. You're not gonna find them on a Zoom call, most likely. Whether you like it or not, you're gonna most likely find those mentors in the office or in the university, in person, and engage with them. There's a lot to learn. I think there's an awful lot of people, certainly I'll just speak for myself and my colleagues. There's an awful lot of us who want to figure out a way to help, to be supportive, to share what we've experienced and lessons and things like that. And it's not just because we're, all these old people that think they know everything. I think we fully appreciate what you've all been through. So you're going to be a really interesting cohort through history. You're a little bit celebrated right now in certain ways. Take advantage of it and ask for help and ask for that mentorship and show up and be present. And that's probably the best thing you can do right now. And on top of that, if you can figure out how to do anything with data analytics and AI and all of that, that's coming so fast to the real estate business. It's going to make our heads spin, I think, over the next handful of years.
Thank you, Mike. That is wonderful. And to all of you who have joined us, we're appreciative. We hope that you've enjoyed this presentation. We look forward to being with you again next month. Have a wonderful afternoon. Take care. We'll see you next month. Thanks, Mike.
Thank you.